right. Good afternoon, everybody. Welcome to the 11th Annual Value Investors Panel at Creighton University. My name is Dayton Rand. I'm a senior finance student here at Creighton, and I participate in the Portfolio Practicum program here. For those of you who don't know, the Portfolio Practicum is a year-long class offered at Creighton in which a select group of senior finance students get to manage a small portion of Creighton's endowment. It turns out it's about $7.5 million, and to the best of our knowledge, this is the largest student-run portfolio that's managed solely by the undergraduates. So we have the Value Investors Panel every year as, for us students, it's a kind of a conclusion to that program, and it's an opportunity for us to have our burning questions answered by people who have the experience and expertise that only come over time, which us as students don't have much experience in that field. So we've assembled a fantastic group of panelists here, and I'm sure we're going to have a riveting discussion on value investing, and we'll have all your questions answered. But before we get to that part, this being Creighton, a Catholic Jesuit institution, we'd like to start off with an opening prayer. So I'd like to invite Father Tom Markle of the Society of Jesus to give that prayer.
Let us pray. Good and gracious God, we recognize that all goodness comes from you, and that you are the author of our lives and the giver of our talents. We are grateful for the opportunities that you provide for each of us to grow, enhance, and enrich our talents. We are thankful for all the people who teach and guide us along the way. Like the sower in the parable of the sower, we seek to put our talent and resources to work for growth. We invest to earn a return that can be put at your service and the service of your people. And so we ask for your blessing of our talents, our efforts, and investments. We ask you to bless all the people who teach, mentor, and guide us. And with grateful hearts, we pledge to make our returns to you. And we make this prayer in your name, in the name of your Son, and the power of your Holy Spirit. Amen.
Thank you, Father. My name is Anthony Hendrickson. I'm Dean of the Hyder College of Business. And as you all know, there's no free lunch. So the obligatory commercial for our college. We strive to be the most connected school of business with real-world practice, and we think we do that in a number of ways. Our faculty have over 500 years of aggregate business experience. Our students do, over 90% of our students do at least one internship. 70% do more than one. About half of our students are doing internships during the school year. We're located within the walking distance of the headquarters of 4 Fortune 500 companies, plus ConAgra that only recently moved its headquarters to Chicago, is within walking distance as well. So in addition, our faculty have not only PhDs, but have other important designations that you would consider in industry. So for our finance faculty, virtually all of them have PhDs, but they're all CFA charter holders. We have more CFA charter holders than any other school in the world. We think that that's an important aspect, and you see some of the results of that education witnessed by young Dayton Rand here talking about our portfolio practicum. Dayton's a fine finance student, going to graduate Unfortunately, he's going to go to med school instead of applying finance. Dayton got the highest score on the MCAT of any Creighton student this year, and that's saying something, because about 65% of the freshmen that come to Creighton come here to be a doctor, a dentist, pharmacist, something in healthcare, because we have schools of medicine, pharmacy, dentistry, occupational therapy, physical therapy, nursing, law, etc. So it's saying something, so congratulations, Dayton. One of the other things that I would tell you is a quick story about the Hyder College. The Hyder College is named after Charlie and Mary Hyder. Some of you may know about Charlie Hyder, but Charlie is an alum from Creighton, passed away a couple of years ago. Several years ago, we hosted Don Keogh here. Don was an alum, former chairman of Coca-Cola, and when Don was here, Warren Buffett came to introduce Don, and when Warren was here, he saw Charlie in the audience and said, there's my old friend Charlie Hyder. Charlie was the guy who got me into the insurance business. And indeed, Charlie and Warren were contemporaries, and Charlie and Warren went to lunch one day, and Charlie said, Warren, you should buy National Indemnity. And Warren said, Charlie, I don't know anything about insurance. And Charlie said, well, you get these premiums and you got all this money to invest somewhere, and it's a good deal. And I believe Jack Ringwald might sell, and if you catch him at the right time. And indeed, that's kind of the history. And Warren and Jack got together, and Warren ended up buying, Berkshire ended up buying National Indemnity. And in 2004, in the annual report from Berkshire, Warren stated that had he not made that purchase, Berkshire would be worth about half as much today as it was if they hadn't purchased National Indemnity. So, and that was in the 2004 report. So that gives you some aspect. Charlie was an investment manager here, was the first person in Omaha to buy a seat on the New York Stock Exchange. So that gives you some history of our legacy with finance here at Creighton University. So that's the end of the prerequisite commercial. I hope you enjoyed that. Please see us if you have any young aspiring business people. We'd love to talk to them about coming to Creighton. And so now I'll turn it over to Dr. Robert Johnson, finance faculty here.
Thank you, Tony. Wow, I look up and see this auditorium filled, Tony. It's absolutely fabulous. I've been doing this for several years. It's a wonderful event. This is a terrific organization, and Tony is an example of leadership matters, and this college is in terrific hands. I would like to introduce my co-chair, David Kraft from Wells Fargo Private Bank. To his left is Whitney Tilson, Empire Financial Research. To Whitney's left is Josh Shores from Southeastern Asset Management. To his left is Susan Schmidt from Aviva Investors. And to Susan's left is Ted Bridges from Bridges Trust. And finally, to Ted's left is Bob Hagstrom from Equity Compass Investment Management. And the way this is going to work is for about the first hour, David and I are going to alternate asking questions that the students have provided. Again, the Portfolio Practicum class is the sponsor of this event. And a question will be directed at a specific panelist, but the other panelists can join in and provide color if they would like to. So we're going to start with a question on security analysis. And the student question is, Warren Buffett has often said that value and growth are joined at the hip. How much emphasis do you place on projected future growth when valuing a company? Whitney?
Hi. Well, Warren Buffett, with the purchase of Amazon, I guess no longer a value investor.
Well, wait a minute. Now, he didn't buy Amazon.
He blessed it, for
Ted
sure.
or Todd?
He blessed it, and if you look at, when he talked about it yesterday, he's clearly sort of tickled that one of them finally broke down and did what he has long regretted not doing.
Right.
I've actually written a couple articles saying you haven't missed Google either. That's the next tech stock I think they might add to their portfolio. Growth is one of the big mistakes I made in my career is this is my 22nd consecutive Berkshire meeting, and so, I'm a dyed-in-the-wool value investing disciple of Buffett and Munger, but I looked in the pool of statistically cheap stocks and then tried and find good businesses, and I had it backwards. I should have spent all my time trying to identify great businesses, long-term compounders, and then in that pool looked for companies that were temporarily out of favor in the market. And obviously, so 75% business quality, which a very important component of that is the future growth prospects. And 25% is the valuation on the way in. And I had that for almost my entire career reversed. Warren Buffett had that entirely reversed for the first 20 years of his career. He was just a cigar butt investor, and Charlie Munger helped him become more of a high-quality business investor. But, they figured out that sort of transition started to happen in the 70s and 80s, and it took me till the 2000s, long into the 2000s, to figure it out. So shame on me, but you guys are young mostly, as I look around this room. Focus on high-quality businesses, and being right on the quality of the business is 75% of what matters. Being real clever at buying it cheap on the way in is at most 25% of what matters.
Okay. I'll send this next question to Robert. How do you identify and avoid value traps?
Well, I'm still learning. But, to kind of riff on what Whitney says. I'm sorry.
Use the microphone.
Got to do that. Okay. All right. To kind of echo what Whitney says, it's interesting. Value investors are categorized as long-term investors.
Bob, you still need to move that microphone. Put it right in front of your mouth. Just pull it over. There you
All
go.
right. How's that?
Right.
I'll start
I
singing.
think people in the back of the room are going to have trouble hearing you.
Value investors have long been thought to be, as they should be, long-term investors. And what Whitney was pointing out is that if you're going to be a long-term investor, it's better and more beneficial to be a long-term investor of a good business that's growing over time than a bad business that doesn't grow. We kind of got it flipped upside down, and we began to buy statistically low PE type stocks that ended up being very bad businesses, and avoiding, for a time period, higher multiple stocks that actually were great business. And Whitney points out, very nicely that we might have had that backwards. To avoid value traps, what we're trying to do is buy businesses that have a long capacity to invest money at good rates of return over time. And in my portfolio, as I've been doing for 20 some odd years, we're more global in nature because we believe the long-term opportunities for compounding growth are on a global stage, less than a domestic stage. And if we just buy simple, attractive businesses that sell products and services that are going to be in demand by consumers around the world, that seems to be a sensible way in which to avoid a value trap and be on the right side of a good business.
Josh, did you have something?
Sure. I'll add on to that. From our own discipline, we very much are value focused. We still want to buy a margin of safety. I mean, your ideal situation is a really good business where something has gone wrong and that margin of safety is still present. I'm entirely non-U.S. focused, so there is a bit of a broader, I think, deeper opportunity set, at least at the moment, than there perhaps is domestically. But just internally, one of the ways that we have found to be helpful in avoiding value traps is we monitor everything on an intrinsic value basis. So, what would a sophisticated private buyer pay for 100% of this company, normalizing for non-earning assets and perhaps some construction in progress that hasn't yet turned into generating cash flow, and this business that could be sold or this one that could be optimized, et cetera, and there's your intrinsic value. And for us, if that intrinsic value is not growing steadily because we're looking out over 3, 5, 7 years, then we've missed something, right? And so an intrinsic value that's stagnant or falling, oftentimes, from a process point of view, is indicative of a value trap and something where we will then, reevaluate or reassign to take another look at it. So there's the philosophical side on the way in of trying to avoid a value trap, but then there's the ongoing process focus of saying, okay, here's everything that we own, which for us is 20 or fewer companies, and is something not tracking with where we think those values should over time? If not, there's probably something wrong in our case, and perhaps it's pointing to that sort of trap.
Thank you. Did anybody else have any comments about value traps, or we can move on to the next?
I'll move on to Ted. Given the vast amount of information available, what is your routine to stay informed and potentially obtain an informational advantage?
That's a pretty tough question. I was.
I told you there'd be no tough questions.
You said they would all be softballs, and that was like a slider on the low and away. I'm tempted to take it, but I'll try and punch it to right field and at least get on base. Before maybe roughly 2000, the early 2000s, I think there was maybe a possibility of having, in a sense, informational edge. I think with Reg FD, the ability to, in a sense, have a sustainable informational edge is pretty much gone. And I think, I remember, and this kind of dates me, but I used to work for my dad back in the 70s, and research then was go get the Moody's manuals, which were about a year old by the time you got them, and they had the prior year's information in them. So basically, by the time we're making decisions, that data at best is 18 months old. So I think the issue's now flipped. There's so much information. How do you order the information that's available? And what we try to do at our firm is maybe have 2 or 3 or 4 aspects to our process that help us, in a sense, cut away information that doesn't really matter. And I think some of the answers to the questions already really kind of hit on that. Understand what works for you as identifying a good business, focus on those variables. And I think we try to be pretty long-term in our approach. We have a lot of taxable clients, so they're interested in deferring taxes as long as possible. So once we own a company, we're probably less worried about valuation and more focused on are the data points coming over time still supportive of the notion or the themes of the drivers of value that we saw in the company over time. And so I think we start asking questions that are more along the lines of, is it still yes, not when is it no?
I'll add on to that just a little bit, because this is the age of technology. We have information flowing over us and around us all the time. So it's impossible to weed it all out. And, I stopped reading the Wall Street Journal, and people were shocked. What do you mean? This decade ago. I'm not reading it. I don't have time. So there are so many other places, whether it's Bloomberg, it's news reports, but when you're looking at your portfolio and you're looking at your investments, yes, there is a ton of information out there. What's relevant to what you own? If it's not relevant to the business model, I don't have to spend that much time focusing on it. So I think, we always fight to be aware of everything that's going on, but when it comes down to your investments, it takes some discerning to sort it out so you don't get cluttered. You can't see the forest for the trees kind of thing. Make sure you're focused on the things that are relevant to your investment thesis and your business.
Okay, I'm going to direct the next question to Josh. He mentioned international investing earlier. Is there a difference in value investing in different parts of the world?
Good question. So I would say that from a core, be long-term, buy with a margin of safety, buy high quality, be contrarian, take advantage of Mr. Market, all of those core, religious tenets, if you will. No, there's not a difference. But we have learned over 20 years of building out our non-U.S. footprint that the application of those principles in different countries around the world is slightly different. And one example, kind of an easy example of that, is in some parts of the world you can be much less comfortable investing with an agent CEO. So, for example, parts of Asia where our coming from kind of a U.S. mindset perspective on how a management team is going to behave, how they're going to allocate their capital, how they're going to think about shareholder primacy, doesn't necessarily hold true. And so partnering one with management teams that have significant skin in the game, either they're owner-operators or the family's a significant owner, or on a personal basis they've built up significant wealth, can really help narrow that range of possible outcomes as you look at what behavior could be over the next 5 to 7 years. And that's a real simple example of saying, okay, this mindset that you perhaps have honed in the United States, and then you sail over to Spain or to Tokyo or Hong Kong and say, okay, here's my playbook, I'm going to apply it here. The core conviction and tenets don't really change, but yeah, the application of them can be very different and nuanced by market. So the only way to pick that up, at least in our experience, is to have done it and have the scars to show for the mistakes that you've made, and kind of reps over time, and then you learn a little bit better what works and what doesn't.
Thank you.
I'm going to ask everybody to respond to this question. I'll start with Whitney, and we'll just go down the line. What's the best business in the world today? What characteristics make this company so elite?
Well, I'd have to agree with Buffett that Harvard is the best business in the world. It's got the best brand name on earth, and they have infinite pricing power, as we've seen from the recent scandal. Right? Right? Look what. They could jack their tuition to $1 million per student and have absolutely be wildly oversubscribed, right? So he's right about that. The Hong Kong horse racing track is, I remember when I visited it 10, 15 years ago, that one track generates more revenues in gambling than the entire state of Nevada. It's a nonprofit. It's the most wildly profitable nonprofit on earth. That was a pretty incredible business. Combining a monopoly with the people in Hong Kong just love to gamble on horse races. So those are two a little bit out of the ordinary, and I'll give you the two that I think are the greatest businesses on the planet that you can invest in today, that I in fact recommend to my readers in my newsletter. Google and Facebook have the two best business models. Infinite returns on capital, have expanded globally at virtually no incremental cost. And I think it's both companies, especially Facebook, have done their best to shoot themselves in the feet and still can't help themselves but earn 40% operating margins. If you can hold your nose, especially in the case of Facebook, and their obtuse behavior is sort of disgusting, but I own the stock because I think I can tell you from running a small business, we just did a campaign to launch my newsletter. We spent, $1.5 million, and $1 million of it went to Google and Facebook. And we launched with, 100,000 people tuning in to a webinar and raised $14 million in revenue. So we spent $1.5 million, took in $14 million, and virtually all of that went to Google and Facebook. So I'm just telling you, that means they have pricing power. They can raise their prices over time, and I don't think anyone will dislodge them. So those are two stock recommendations for you.
How about you, John?
Well, I'm going to sidestep that one a bit, because if it's the best business model out there and I want to own it, but it's not cheap right now, I don't know if I want to confess that to everybody. But the largest position that we have, our highest conviction thing in our non-U.S. funds right now, is in a quasi-Italian company called Exor, which is a combination of some phenomenal businesses, one of which, Ferrari, perhaps is one of the best businesses in the world. If you look at brand value, pricing power, they decide who buys their cars, especially at the high end, not the person who wants to buy the car. They say, you're going to buy this one and you'll pay this price and we'll get this margin on it, take it or leave it. That's phenomenal business. But you wrap that within Exor, which is the legacy Agnelli family holding company that controls Fiat Chrysler, which is really Jeep and Ram, Case New Holland, Partner Re, which is the reinsurance business, Ferrari, Juventus, the soccer club, and then a smattering of other things, with a phenomenal capital allocator and long-term thinker who's still in his early 40s sitting at the top. It's actually something that's investable today that I think has a long-term time horizon of compounding. And that holding company structure is one that in some parts of the world we're happy to see go away and break up and create opportunity, and we could circle back and talk about where that's appropriate. But in some places, it's a phenomenal vehicle for leveraging the power of the people at the top. And I mean, this is a great example of why everybody's here. There's the holding company par excellence that has leveraged the power of the people at the top through its model to generate gigantic long-term compounded returns. And Exor, while certainly not following exactly that model, has that sort of potential, is investable today. And while everything they own isn't necessarily Google, I'd say Ferrari is in that echelon at least. And you're getting it at a double discount because it trades at a discount to the sum of the parts. You're able to put a bit of leverage at the top co, so the growth at the sub-companies is compounded even more at the top. And then the chairman and CEO buys back shares intelligently.
Susan, what's the best business in the world?
All right, so I'm gonna dodge this a little bit or confuse you all because I'm gonna have too many names. I don't think there is a best business in the world. I don't think you can get that. I don't think if you put something in your portfolio, you can count on it to be the best thing you own always and ignore it. And so I think the best businesses in the world, you know, we're mentioning the characteristics of them. So it's a strong brand name, a moat, they do something special. They are, you know, led by a management team that understands that they don't own the company, the shareholders own the company, and their job is to make sure they maximize return for the shareholders. I love businesses that produce cash flow. Not every business produces cash flow when it's just getting started. Amazon had years where it didn't. So there's a lot of characteristics that you look for, but those characteristics change. And I think you can have a best business, but you have a best business for a period of time. Right? So right now, I like Western Alliance. It's a bank out of Nevada. I think it's incredibly well positioned. It's a great multiple right now. I think they're, you know, 20% plus return on equity. They're, you know, well positioned to take share. I like Teleflex. It's a med tech company. It's got a great pipeline of products that are coming out. Again, I really like the management. They're super smart. They're returning things to the shareholder. I had to check on Teleflex to make sure I still liked it because one of my favorite CEOs of all time led that company and he retired. And I had to go back and look at it. And the thing that, you know, I could sleep at night owning that company. I knew it because Benson Smith was running it. If Benson's in the audience, he'll probably fall over. But if Benson Smith was running it, he retired. I had to go back and look at, do I trust this management team to run it in the same way? I do, and I still own it, and I've owned it for a long time. But could that turn on a dime and not be one of the best businesses with one of my highest free cash flow returns? Most definitely. And so, and I can go through all these industries and say that, but I think what's important to note here is there's never, I'm always a nervous investor, right? I want to protect to the downside. I love getting upside, but I want to protect my capital. I'm ready for some new innovation, something to change at any moment that can take away the value and the moat around what you own. And so I think you always have to be looking out for that, and it changes.
If I think about sort of the characteristics, kind of what Susan said, I think, you know, to me, it would be a company that has almost a monopoly, like a duopoly or an oligopoly, that would have really high returns on capital and equity, that would generate a lot of free cash. And I would kind of say that the ability to generate that free cash, if used by adroit, smart, forward-thinking management, could be used as a competitive threat to push the moat further and kind of defend the waking up and discovering that your favorite business is all of a sudden under significant competitive threat. So we think a lot about runway and market opportunity. I think Google fits that incredibly well. So we own a lot of that. What I find fascinating is if you'd have gone back 20 or 30 years ago and said, boy, what would be just the most incredible company? It would be something where you could just sit down, get the answer immediately. It would have, 50, 60, 70% market share in advertising, I think, which advertising years and years ago was kind of a Berkshire Buffett staple. Because if you're going to do business, you have to have access to consumer. So Alphabet really fits, and I'm just fascinated and maybe pleasantly surprised and enthused that, they put up a quarter that's 19% year-over-year revenue, and that's deemed to be disappointing. And I will have one of my analyst guys next week run a screen and say, how many companies with a market cap of 10 billion or more are showing year-over-year revenue gains of 19%. There's not very many. And so the fact that the market finds that disappointing, I find sort of in a contrarian sort of way heartening. The other business that we really like would be payment processing. We know a lot of MasterCard and a lot of Visa. And again, I read every article I can on blockchain. I still don't really understand blockchain. You know, I guess I look at Visa and MasterCard and think they're incredibly well positioned as far as I can tell, and they do generate a lot of free cash, and they buy their stock back. We stupidly periodically sell it, and it's pretty much always wrong to do that, but it's still a big position, and we're trying to figure out ways to minimize the stupid portfolio management tricks as much as we can.
Well, I guess the question kind of evolved. I thought I heard at the beginning that maybe what would be the best long-term business, and I thought about it in terms when Warren bought Coke and said, if I could only make one decision and not change it for 10 years, and my family's net worth was dependent upon this idea, that changes the scope, and I would pick something like Nestle. I mean, I could go away, and Nestle's the world's largest food company. There are 5 billion people in Southeast Asia coming into middle-class status that love their products, and I could go away for 10 years and come back, and I'd have a very good investment in Nestle and never have to worry about anything. But undisputably, fact, quantifiable, the single best business on the planet is Amazon. It's the fastest growing, highest return on capital business that has a tremendously long runway. It is number one in 2 dominant business, online retailing and cloud. And soon, despite I do own Google, not Facebook, it will become the world's largest advertising business. And you can already see the migration of money beginning to move away from Google to Amazon. If you look at the WPP quarter report that just came out, they shifted $300 million away from Google to Amazon because Amazon actually has a better advertising source for people that want to advertise because they know exactly what the client is buying and compare other like products to that to advertise. That doesn't mean that Google won't be a great investment. It will be. But this grows faster than Google. It has a return on current capital somewhere around 125%, and that's the only second company in the world that's ever done a better than 100% return on capital. But it gets 225% on incremental capital. So quantifiably, undisputably, Amazon is the single best company, economically speaking, on the planet.
By the way, Bob just said something that validates what Susan said. I had the great pleasure of interviewing Mr. Buffett on stage at a CFA Institute event in 2011. I asked this very question, what's the best business in the world? He didn't bat an eye, and he said Coca-Cola. He said the reason is people, there's a store on Fifth Avenue where people buy Coke branded products. They're willing to buy Coke branded products and do advertising for you. There's not a stronger brand name than that, but I think Susan's right. That changes over time. I've done this a few times. My mic is on. I'll just have to scream, which I've done at students before. So if you want to go ahead.
Sure. I'll direct the next question to Susan. Buffett famously said, be greedy when others are fearful, and fearful when others are greedy. Do you consider overall market sentiment when making purchases and sales, or do you mostly ignore the market when making decisions?
I don't think you can ignore the market. I think you have to know. When I was starting out, one of my mentors told me that remember that every time you buy a stock, the guy that's selling it to you has owned it a lot longer than you have, just by nature of the transaction. So why are they getting rid of it? And I think you have to understand where the market is and sentiment. And I think a big part of being a good investor longer term is determining what makes sense to you in terms of valuation and what you want to reward over time. And then staying the course with that, because the market is very emotional right now. You know, it's changed over the last couple of decades. We have more and more participants. We have high-frequency traders. We have all this noise buffeting it, and you get you can get a sentiment swing. We had a great example, Christmas Eve, huge sentiment swing. Did anything really change on the fundamentals of the companies in the market on Christmas Eve? No, but we were in free fall. So I think you have to be aware of what's going on out there, and I think it helps, and it gives me comfort to know, am I ready to say, I'm different, I'm buying it, you're selling it, I'm buying it because, and I know where I'm different. I think that's where your successes are. When you know where you're different from the market and why you think the market is wrong, that's when you have your best investments.
Thank you.
Josh, in school, we're taught that risk is nearly synonymous with volatility. But many value investors view risk as the prospect of permanently losing capital. How do you define risk?
Oh, that's an interesting one. I feel like in the business school, I'm on dangerous ground to be talking much about this, especially since I studied philosophy in college. But from our perspective, very much it's permanent loss of capital. And volatility becomes a risk factor if your time horizon can be truncated, either because of leverage or because you don't have the right kind of clients or you don't have quasi-permanent or permanent capital such that you can see through the volatility cycle. Then yeah, volatility is a risk factor if it could punch you out or you can't stay the course on your thesis. So it's important from our point of view to have the right kind of clients, and I would say from a Southeastern point of view, we manage about $15 billion, about 10% of that is our own capital, and we have to have all of our money in our funds. There's no personal account, there's no thing over here. We're totally private, we're thinking and acting like owners in whatever we do, including the investments that we make. And so like your ultimate alignment of interest for the clients that come alongside of us is that it's our own money, and it's this quasi-permanent capital that we can't get shaken out because of just, a temporarily volatile market. So very much it's being wrong, permanent loss of capital. Don't lose money is our rule number one, but I also understand how volatility can be a factor of risk, particularly if you have a time horizon constraints.
No, I like to wait. I've spent a lot of time thinking about this, and I don't want to damage any students who have to take final exams on modern portfolio theory, but if you do an anthropology kind of dig on how modern portfolio theory came to fruition, it really is quite fascinating. So you'd have to start with Harry Markowitz. So here's Harry Markowitz, I think Chicago, 24 years old, looking for a dissertation idea. And he, does the efficient frontier, does risk and return, and that was good, more risk and more return, that makes all sense. But then he decided, out of the blue, just, hey, I think risk is price volatility. Now, this is 1956, and security analysis had already been out for, what, Whitney, 12 years, 34? 12 years, could have read security analysis where, as we correctly, Josh points out, it's permanent loss of capital. The Intelligent Investor, which is a best-selling book, New York Times, was out in 1949, which Ben Graham says, it's not price volatility, it's permanent loss of capital. But this guy says, no, I'm going to say it's going to be the volatility of the stock price. And he, by the skin of his chin, actually got that dissertation through. 6 years later, William Sharp, 24 years old, looking for a dissertation idea. Professor says, go see that guy Markowitz. And he goes and sees Markowitz, and they talk about it, and he comes up with beta, which is, I can figure out volatility of the stock relative to the market. It's all about price risk. Here again, nobody looked up Ben Graham to say, is this the right way to do it? Now, what becomes interesting is nobody did anything with those ideas until 20 years later, 15 plus years later. It was 1976 that all of a sudden, after the 73-74 bear market, when we obliterated half the money in that market, that somebody said, we've got to do this better. They looked around and found these 20-year-old dissertations and said, maybe that's the way we should do it. And that began the whole genesis of modern portfolio theory. It happened in a void, and the only thing that I regret is the people that followed Graham and Dodd back then should have said, raised their hands and yelled, this is not the way to do it. And they didn't yell loud enough, long enough. This thing took root, and 35, 40 years later, it's still insane that we're following this methodology to determine how to allocate assets and think about risk. It makes no sense. Don't write that on your final exam. You won't have it. And your professor will get very upset with you. But I had to get that off my chest. It's been building for quite some time.
Can I just...
Actually, I think there are several professors here that would agree with
You know what? I got to tell you about, the more I talk about this, I'm getting some profs that are saying, you know what, I'm sick and tired of teaching this too. But the problem is, what else are they going to teach? Now, what do you teach? If you don't teach this, if you're going to say this paradigm doesn't work, you got to come up with another paradigm to put it in its place. And that's where I think it can be interesting for the next generation, which is, if it's not modern portfolio theory, what do you want to put in its place?
What Bob said, and I would jump on that. That was just fantastic.
Oh, good.
That was really good. And
It always sounds good when I say it to myself. But
No, it's awesome. But I, truth be told, I'm a huge fan. I read the books when they came out, years ago. But I would say I'd take it one more step further, and in the 80s, and with all due respect to the CFA group, level 2, which I'm sure some of the Creighton kids are going through level 2 or level 3, and they have you spend 3 or 4 hours in a test, and you're disaggregating fundamentals and industry and sectors and tearing up balance sheets. And at the very end, the last part is like, how are we going to value this stock? And it's like, well, capital asset pricing model. And it's like beta. And at the time, I was just like, oh man, I really want to be in the fraternity. It's like, it's hazing. Like, I've been here for 6 hours. I'm not going to blow it up now. I'm like, okay, beta's 1.2 times whatever. So, Procter & Gamble's better than Colgate or whatever it is.
Yeah.
And what Bob said is exactly right. I think the least valuable statistic is beta. And if anything, I think Buffett would turn it around and say it's your most powerful friend to the extent it exacerbates the difference between where the price is and what it's really worth, and allows you the opportunity to sell it at a really high valuation relative to what it's really worth, or buy it at an extremely discounted valuation relative to what it's really worth.
All right, I'm going to jump on that too, just because we all feel strongly about this, clearly. Beta, what is beta? It's backward looking. I love buying turnarounds. The historical beta, if this management team executes a good turnaround, has nothing to do with the beta going forward. I don't care what WACC is. The cap and pricing model, it doesn't work for me, and I don't use it. Sacrilege. And again, don't write any of this on your final exams. None of us will ever get invited back now. But it doesn't matter, because beta is backward looking. So we'll just compound it even further and say, does this interest rate environment that we have right now look like anything we've seen in the past? No. So it's not applicable. You have to make these adjustments, and I think that what we're teaching in the textbooks is a framework that it's a nice conceptual theory to start helping you wrap your mind around some of the things you think about, but it's some of the things you think about, not all, and sometimes it involves things that aren't relevant to why you're investing in that stock.
Yeah, I was judging the Wharton stock picking competition last week. 3 finalists. One of the ideas pitched, and it was a good idea, was Kone, K-O-N-E, one of the largest elevator manufacturers in the world, based out of Finland, trades on the exchange over there. Stock's at $54 or something. A good chunk of their business, probably 60% of their EBITDA, if I recall, is from China, and trades at 25 times earnings. It's a good business. And the reason I'm telling you this is because he showed different scenarios, and his downside scenario was the stock falling to $46 to 22 times earnings. And I just said, are you frickin' kidding me? And I see this all the time, especially among young people who haven't gotten destroyed and who didn't live through 08. Your downside is always 0, okay? And don't forget that. And maybe Berkshire Hathaway is the one exception, but even then in 08, Buffett said we would have gone to 0 too if the government hadn't bailed us out, even Berkshire, right? So this just gets to a total misunderstanding of risk, portfolio management, overconfidence, I was just scribbling down more than a half dozen stocks where I've seen personal friends of mine literally destroyed, out of business, because they fell in love with a particular stock, oversized it, and then chased it down, and it just turns out they were wrong. The biggest example, anyone want to know, what's the biggest loss in hedge fund history? What's the stock? Who's the manager? Dollar loss. Valiant, $4 billion, Bill Ackman, who's a close personal friend from college. All of it manifested, and this is one of the smartest stock analysts in the world, right? But he was, one thing that is sure to turn your brain to mush is to become a billionaire and then have a 50% year. And I warned him about it. and he had to lose $4 billion before he learned this lesson. You need to have some diversification, and you can be wrong, and don't oversize things, and be careful of leverage and so forth. So I could go on for about an hour on risk, and but that's a pretty good summary of some of the lessons that I hope you guys can learn. There are only two ways to learn things: is get scars on your back or learn from other people's hard experience, right? I strongly suggest the latter, but myself included, we all seem to have to learn via the former.
Well, since we're talking about risk, I have a tag-on question, and I'll ask everybody to give a quick answer, and I'll start at the other end with Robert first. When managing your portfolio, how much emphasis do you place on diversification, and how many long positions should you hold at any one time?
Well, we're definitely concentrated portfolio. We're between 20 and 25 stocks. And, I'm sorry, thank you, Whitney. We're concentrated portfolios. We run 20, 25 stocks with an 8% turnover ratio. And that's because, it wasn't only because Warren had been doing, remember Graham had a ton of stocks. He was broadly diversified, not so much high turnover, but Warren was, one of the first that began to reduce the number of stocks. And then when we wrote the portfolio book, we looked at, the partnership, we looked at Charlie Munger, and we looked at Bill Ruane Sequoia, Lou Simpson, even John Maynard Keynes, and they all ran very concentrated portfolios. And they had tremendous long-term track records. But they had high variability of returns, but their clients, forgave them for it, whereas today that's a little bit more difficult. And we do have people that we manage money for that's retirement money and things of that nature. So we can't get down to 4, 5, 6 stocks. So, but I think 20, 25 is a good number. And a lot of guys seem to be heading in that direction. Tom Russo is probably 16, 17 stocks, but anything less than 10 probably makes me nervous. Anything more than 25 or 30, I'm like, make up your mind, just buy more of one thing than buying a lot more of everything else. So that's kind of how we think about it.
We run basically two strategies. One is sort of a core strategy that's sort of 40 to 50 names. It's probably, I think it's at 47 right now. That isn't so much for diversification. We're able to find good ideas that we think fit. And even at 40 or 50, we think there's enough differentiation relative to a benchmark that we can be, in a sense, differentiated. We also run a concentrated strategy that is around 15 or 16 or 17 names. It obviously has a lot more day-to-day, week-to-week, month-to-month volatility, but for the right clients, they don't care. And I think the world has become so competitive, it kind of circles back to the informational edge question. It's extremely difficult for active management to beat indexes. So you almost get to a point philosophically where you say, if I want the asset class return, I might as well just index it. If there's something that says we can do better by owning great businesses over the long run, then probably 15, 20, 25 is the right number, because that's going to give you enough differentiation to really have your best ideas have the most impact in the portfolio.
So I've run portfolios on both sides of this. I've run the 15 to 17 name portfolio. I've run portfolios that are about 70 names, and I've had to take over portfolios that are 120 plus names. I'm not a fan of the 120 plus. I think that's too many. 70 is, I think, a good tempered amount when you have investors who can withdraw their money at any time and might need it at any time, and it reduces the volatility. When you have 15 to 17 names, you're making big bets that, I really believe in this company, and I think it's going to work over time. But one of the reasons you really believe in it and you think it's a great value is probably the rest of the market doesn't right now, right? They're not so keen on it, which is why you're willing to step up and buy more of it. And that introduces risk to your portfolio. So when we talk about hedge funds and they're taking big bets, hedge funds are gated. You can't withdraw the money right away, right? If I'm an investor in a hedge fund, the hedge fund PM, I always say, has got this great gig because they can hang on to your money for a minimum of X number of years before you can get it back. So they're forcing you to be patient. So even if you're going to panic about the market, You can't do anything, so you have to ride it out. And if their bet is right, you're going to make money on that, and it's good for you. Human nature fights that. So I have a bunch of portfolios that I manage for big pension funds who can withdraw at any time. They don't have the patience for that kind of volatility. It makes them very nervous. And when people get nervous, they want to reduce risk, and so they go to cash. So we've all talked about it. There's a place for those different portfolios. You just have to understand the volatility and the risk that it introduces and what that does with human sentiment.
So our natural wiring is 10 to 15, and we have some clients who can do that, but the majority is a little closer to 20, so say 15 to 20, kind of 99% active share, zero attention paid to what the index is or really the geographic weighting. We're a concentrated private equity mentality in the public sphere, and to try to counteract some of those risks, it's really important to have the right kind of clients and to have your own capital at play and quasi-permanent capital, and that people know what they're getting when they invest with us, because there will be a little bit more volatility, but to differentiate yourself from the market and generate outperformance and excess return, you have to be doing something different. So we're pretty concentrated, and me personally, 10, 12, 15 is great, but some of our clients can't quite do that, so we'll go up to 20.
Look, I put all my kids' college money into one-third Berkshire, one-third Howard Hughes, a real estate company I've owned for 10 years, and one-third equal division of Google, Facebook, and Amazon. And so that was my 5-stock portfolio. That was how it was weighted, and I didn't even think about it, and it crushed the market. So if you're just have some long-term money you want to forget about, you can do as few as 2 stocks. I'd be totally comfortable owning half Berkshire, half Google, and not looking at it for 5 or 10 years. But if you're running other people's money, you can't do that. That's too concentrated. So, I'm probably where Bob is in the 10 to 20 range. In the newsletter that I just launched, we launched with 5 stocks, and we'll get to 10 to 12, and that'll just be the number. I do think in a world increasingly dominated by index funds and increasingly sophisticated supercomputers that are now playing the value investor game and arbitraging away the way we all used to make money, like early in my career. There are 2 things you need to do. You need to concentrate more, and you need to trade less. Higher concentration, lower turnover, I think, is the only way active managers can beat the supercomputers and the index funds.
Yeah, but I'll just tag on. So everybody at this table said the same thing. They don't own a lot of stocks. Yet the entire industry is taking money away from active management and putting it to passive. So what's the disconnect? So I worked with this guy, Bill Miller, for 15 years, and he said it's not that active management doesn't work, it's the strategies used by most active management that doesn't work. So if you go to Morningstar and say, tell me, of all the mutual funds, give me a distribution of how many stocks and what the turnover ratios are, about 94% of all the mutual funds at Morningstar have more than 100 stocks in their portfolio and more than 100% turnover ratios. Well, that's not going to beat the market. But that is the grand scheme of what active management is. What's happening at this table here is in the tails. There's just not that many people doing it. And why are not that many people doing it? Because the grand scheme of investors do not want that variability and volatility of the month-to-month, quarter-to-quarter returns. It takes a very unique investor to be able to do that. But it's not that active management doesn't work. It does work. Financial Analyst Journal does high active share, and they're very clear. To the degree that you reduce the number of stocks in your portfolio, Kremers and Fetajusta will tell you increase the odds of beating the market, stock picking being the critical variable. But in fact, we have an industry where that's only 2 to 3% of the active management process, and the rest of it has hundreds of stocks and 100% turnover ratios. That money should be taken away, but it's not because active management doesn't work.
Right. What you're describing is intuitively obvious. It's incredibly difficult. I found myself really struggling when I ran a hedge fund for 17 years to follow the premises that are so obvious, because you want performance to be good in the short term, even if you've got great long-term investors, you feel short-term performance pressure. If you ever have the misfortune of working for any kind of large institution, you are being evaluated on a month-to-month basis. But even though I had individual investors who've been with me for a long time, I felt short-term performance pressure. It messed with my head. Part of the reason I keep coming out to the Berkshire meeting for 22 years in a row is to try and combat that kind of short-term thinking. But, I was better than 98% of people at it, and I still wasn't very good at it. It still cost me dearly. They'll saying, don't just sit there, do something. In money management, it's the opposite. Don't just do something, sit there.
That is 100% right. And to me, the biggest issue in the institutional money management world is the disconnect between what the client's true time horizon is and the frequency and the timing of how they are being measured. And it's an issue because if you thought about another great business, you could say Las Vegas is a great business because the odds are very much skewed in the house's favor. And if you said, would you rather bet on Bellagio's take in one day or over 10 years? I think most people would say, well, on any one day, they might lose money, but over 10 years, the odds are very much in their favor. And companies are like that. And the market doesn't price companies efficiently on a day-to-day basis, but it does a pretty good job over 10 years of doing that. The problem is consultants need to get paid for sending you a monthly report, and you've got all these statistics like, I don't know, downside capture. I mean, if you read Buffett's shareholder letter this year, and he had the little part about, well, the first day I ever bought a stock and the S&P's up like 5,280% since then, and all I could do is recite all of the negative headlines that happened over those 50 or 60 or 70 years, but the S&P was like compounding at 10, 11, 12%. So the point there is take away the noise, think really long term, and then you can sort of, in a sense, have a connection between the time horizon over how you're evaluating the business and the time horizon over how you're evaluating the performance of the manager who's finding the great businesses to invest in.
But it's not the investor's fault.
No.
The problem
Well,
is our industry only gave them one thing to look at, which is price.
Right.
All right, so if that's the only thing the individual can look at is price, no kidding they don't want that thing bouncing around. It's a behavioral issue. They gave out Nobel Prizes to Kahneman and Tversky, said people don't like this. But what does Warren do? Warren uses look-through earnings, which is the economic progress of the combined portfolio, to judge the progress of the portfolio independent of the price. He looks at price, and price goes this way, but he's more concerned about the economic progress. We've never institutionalized, as an industry or philosophically, the idea that we should be showing the economic progress, and you can pick your economics, pick cash earnings, whatever you want. We've never institutionalized the ability of clients to know what the economic progress of their business is. We've only given them one thing to look at, and we complain that they're all mad at us because that one thing gets out of the way. We should have done a better job in educating and institutionalizing that they need to understand the economics of what they own, independent of the price. It's our fault.
I'm going to pivot a little bit because it's front and center in the news, and it was something that Susan mentioned, so I'll direct the question to Susan. You said something about the interest rate environment and the unprecedented low interest rate environment that we're in. Warren has been quoted as saying that if he knew that interest rates were going to remain low for the next 10 years, that the S&P is wildly undervalued. How important is interest rates in your model, in your techniques?
It's important, and it's become increasingly important in this time frame, right, since 2008, because things are so different. We don't have an equivalent period to go back to, and we have it's not just us, it's global. So we have a very international economy, if you will. If people think about things in big terms, it's very hard to see how we can really raise interest rates and survive as an economy when Germany can't get interest rates above 1%, right? If I'm getting 0.5% over there and suddenly you could get 3% here, where do you think the money wants to go? And then the dollar changes. And I think and then on top of that, I'm the financials analyst, so I invest in banks. So interest rates are very important to me on that front too. I think that there's a bigger macro environment that is impacting so much right now, not just within the U.S., you have to think about where it is globally, that it matters, and you have to pay attention to it, because it's not the norm. Things have changed. You can't go back and say, well, it was just, I remember when they were at this rate and it was in the 70s. It's just like that. It's not. It's not like anything we've seen before. So, not just in our economy, but globally, with the developing economies and the pace at which they're developing, all those influences change things, and I think you have to consider it. It's not your primary driving valuation metric, but you need to know what's going on.
I just find it so interesting that people will say, for instance, the forward PE on the S&P 500 is what, 17 or 18 now?
Who cares?
And-
Honestly, who cares?
But there has to be a relative to something, and the
Well-
10-year bond is at 2.5%.
Right.
So the implied PE on the 10-year bond is 40. So it's 17 versus 40. Where's that money going to go?
Right. Well, you would think. So, but really, when let's say interest rates are zero, right? Why do we think we had such an attraction into the stock market? Bonds did really well. Why do companies look great? They're giving you a return. Your alternative is zero. I've got an entire generation of students in here who are not used to earning anything on their savings account, right? You guys earn zero, you don't even think about it, right? So your grandparents are really thinking about it, right? They're waiting for that to get back to that 7% interest rate. It matters, and when you look at 0% or 2%, I think there is that equivalent, and it's why I mentioned free cash flow earlier. What kind of return am I getting as a shareholder? So free cash flow, that free cash flow yield for me is really important. You've seen that come down as market prices have gone up. But if interest rates stay this low, 17 on an S&P PE is meaningless.
I would just agree with you there and say we have no idea where interest rates are going, where the S&P is going to go, or any of these kind of macro forecasts. Maybe somebody somewhere does, but it's certainly not me or anybody at my firm. And so we think the best hedge against any one of those scenarios is high-quality businesses bought with a margin of safety, concentrated, held for the long term. And so whether we see an inflationary environment return, they have pricing power. Whether we see a deflationary environment, if it's a high-quality, well-financed company, it's going to surf well through that environment. So we spend 0% of our time thinking about where interest rates are going to go or predicting what markets are going to do, and 100% of our time looking for high-quality opportunities across the world.
Well, Warren said it in the annual report, one line, the single most important economic fact to an investor's interest rates. Everything pivots on interest rates, bonds, stocks, real estate, gasoline stations, whatever. And if you were to ask this whole room, why is the 10-year at 2.5? Why is Japan at negative with the debt situation? It's one of the biggest puzzles economists can't figure out. Japan has 200% debt to GDP. The monetarist, Milton Friedman, that got Nobel Prize, says when you print that much money, inflation goes up and interest rates should go up. Well, they were wrong. And nobody can figure out why debt is so high and interest rates are so low. But because your point is right, if you've got a 6.5% earnings yield in the stock market and you got 2.5% in the 10-year, it should be a no-brainer what you do. So I can only think the legacy is that people just can't give up on bonds at 2.5, which actually, from a businessman's standpoint, who would ever lend money at 2.5% for 10 years? It makes no sense. But we're institutionalized in thinking that we should have some money in the bond market when you really should have none.
Just so the students understand something, when I graduated from college, the 10-year note was at 15%. I just had a reporter ask me if she said, do you ever think we'll see the 10-year note at 4% again?
It's bizarre. I mean, it really is bizarre.
That's how unprecedented this is.
I'll direct the next question to Ted. Switching gears, precious metals like gold are often used as portfolio insurance, but many value investors shy away from gold because it does not produce any cash flow. Is there any benefit to holding gold in your portfolio, whether it's an ETF or as a commodity?
At first, I was going to take the slider loan away in the dirt and hope for a better pitch. But I'll take a stab at it. So I really resonated, I think it was 2 or 3 years ago, maybe 4 years ago. I think Buffett wrote in the shareholder letter, he said something like, if you stacked up all the gold and it was worth X, and he's like, there's no cash flow, and it's, the land is in the United States is far more undervalued. It's way out of my expertise. We don't do anything much as a firm with commodities or gold. I think inherently the issue is it's hard to understand what the value of it is because there are no cash flows. And but it does go to the idea of inflation, which ties a little bit back to the last question, and it is a conundrum. And why is the 10-year at 2.5%? And I kind of feel like somebody's going to be wrong. People that own gold, what is the inflationary push that they see that would make that be an investment that would have value over the next 5 or 10 or 15 years? And I guess my rudimentary understanding of inflation is that's what happens when a good or a service or something is in artificially constrained supply situation. And I'm really hard to think, other than like really highly skilled labor, other than like the really great students that Creighton's putting out, but it's hard to look around the world and say, what is in really short supply? And I think if Amazon is the best business in the world, and I would tend to agree with Bob, I think it probably really is. It's predicated on the idea of you have instantaneous information globally, and it forces competition, and it allows consumers to get the best goods and services at the most fair price. And that, to me, is a very powerful disinflationary force. And I don't think it's a coincidence since, sort of the late 90s or early 2000s when the internet really sort of became of age and became more prevalent, that ability to have all that information and easily access it and access it easily has resulted in a pretty disinflationary world. I think in 2000, the PE on the S&P 500 is probably 25 times forward, maybe 28, and the 10-year was at 6. So today, the S&P forward PE is probably 15 or 16, and the 10-year is at 2.5. Like, they can't both be right, and I agree with Bob. I think the answer is very little fixed income exposure makes sense. And zero in gold. And zero in gold.
That was the answer.
Do any of the panelists have any exposure to commodities or to gold? No. Well, Ted, thanks for taking the slider.
Just leaning out over the plate.
Josh, I hope this isn't a slider, but it may be. I think one of the hardest things for anybody is determining when to sell. What's your sell discipline?
I'm not going to profess that we have it nailed, because that is a very hard thing to do. And our discipline is we have an intrinsic value of the business, as I talked about earlier, what a private buyer would pay for 100% of the company. And that's a dynamic figure. It's growing, so that's why we can own things for 10, 15 years. Sometimes the value keeps compounding and the market doesn't quite catch up with it. But our discipline is when the share price catches up with the value that we are selling. And sometimes that leads to some great companies that keep going up, and you feel sad seeing that happen. But more often than not, it leads to being able to recycle to other opportunities that have a much bigger margin of safety. And the average holding period for us is kind of 3-4 years, although, again, we've had things for 10 or 15, and it's just driven by that intrinsic value estimate.
How about anybody else on sell discipline, because it's so important?
Yeah, I just wrote in my daily email today, coming out here, Berkshire, I owned a dozen of the greatest stocks the last 20 years. The only one I held consistently for the entire 20 years was Berkshire. Everyone else, I owned Apple, Amazon, Microsoft, Netflix, Johnson & Johnson, Pfizer, Home Depot. Go through the list of stocks that were all 5 to 50 baggers. I owned them all, and on average, I might have made 25% on them before I decided they'd run up and it was time to take my profits. And so this is something I've spent a lot of time studying, and you could add a couple of zeros to my net worth if I had simply just hung on to obviously great companies and not been focused on trying to be too clever. So one of the big lessons I teach to young people in my seminars is be greedy. And by that I mean let your winners run. If you're smart and you're clever and you're looking at finding good businesses and all, you will find some great long-term compounders. And you got to be like Tom Russo has held Brown Forman for 34 years, made 70 times his money. My friend Chris Stavru, who's out here at Berkshire for his 34th consecutive Berkshire meeting, he owns Berkshire shares today. Has never sold at an average cost of $1,876 per A share. That's 175 times his money, and he made one good investment his entire life, and that's all he had to do. But you might think, oh, that was easy. Once you found Buffett and Berkshire, it was easy to just hold it. No, nobody has the discipline to hold for 30, 40 years. I certainly didn't. So that's the key. So that is not, though, to say that, hey, every winning stock you have, just let it run forever, never sell. You do have to do something to manage position size. And you have to understand, you can let Berkshire run and become 50% of your hedge fund, like Chris Stavru did, because it's Berkshire and it's super safe, but you can't let something like, Rain Industries, which Monish Pabrai made 10 times his money on, it became 50% of his fund. And Monish is a friend and smart guy and has a great long-term track record. But, when 50% of your fund is some dicey Indian small cap company, you're going to take a lot of pain when that thing goes down 80% after it goes up 10x, right? So you do need to manage position size within reason, but generally be greedy when you hit something. Like I hit Netflix. Every time it doubled, I'd cut the position in half, and I never let it really run. And then secondly, you do have to be aware of if the story changes. So the guys who made a lot of money on Valiant, they made 20 times their money in 6 years before it went down by 97%. And there were two pillars to the Valiant story, and it was a real story. Operating income went up 12x in a period of time that the stock went up 20x, so it wasn't some phony, on fumes kind of story. There were real earnings all the way up, but it was dependent on acquisitions and jacking prices through the roof. And it was very blindingly obvious that when the Allergan deal broke, the acquisition story was over, and when both Trump and Hillary were tweeting about drug prices and Martin Shkreli came along and screwed everything up for the industry, jacking prices by 10% a year, that story was over. So the two pillars of everything that was driving operating income up had just been blown out, and you could have still gotten out of the stock at $200 a share. So you've got to be sensitive to those turns. I did ask Tom Russo, have you ever made a mistake holding too long? Because you've had so many great long-term winners. And he said, yeah, we missed, I rode the newspapers down by 80% before I finally sold, right? So formerly great businesses are having their competitive moats destroyed at an accelerating rate in today's world, and you do have to be sensitive to that.
We've got about a half an hour left, and I would like to start taking questions from the audience. There are folks with microphones that will go around. Who has a question to direct to the panelists? We got one right here. Fellow in the blue shirt.
I got a question for Whitney. Can you hear me all right?
Yeah.
First of all, congratulations for putting your kids through college. I think that's a very good thing to have.
I wish I could say I bought those stocks 10 years ago. I didn't, but...
But my question to you is kind of listen to you guys take us through the whole gamut of the stock market and going back through history. One of the questions I had, in the old days, you picked one stock. Your grandparents might have had AT&T. They used to call it like a widow's stock. My question to you is, at that time, they would give stock certificates. So you had in your possession exactly what you own, and you could see it every day if you wanted to. Talk to me about cybersecurity and how it affects your decision-making as you move forward.
Is your question like, just so I understand, cybersecurity and all is just like if you buy a stock and hold a portfolio of stocks, like somehow they could get stolen out from under you or something like that?
You don't have it. It's just you look at your computer screen, whether it's your iPad or your iPhone, you look at your portfolio on a daily basis, but you really don't have anything.
Well, look, if you're dumb enough to invest in Bitcoin or any other cryptocurrency, you should really worry about that. And hopefully it will deter you from doing anything that dumb, like investing your hard-earned money into something that's going to go close to zero. Not that I don't have strong opinions on that. generally speaking, if you've got an account at Schwab or something like that and you're buying a stock or whatever, I don't think it's really something to worry about. I do know hedge funds that went out of business in '08, though, when Lehman went under, and they had all their capital at Lehman. So during a time of extreme financial crisis where financial institutions are at risk of bankruptcy, okay, now you got a problem. That you may not be able to get access to your capital. I don't think that's I think the U.S. financial system is actually pretty healthy right now. I don't see signs of fraud or, extreme leverage. So I wouldn't spend a lot of time worrying, 99% of people, I wouldn't spend a lot of time worrying about that right now.
You got another question right up here, the fellow with the microphone.
Yeah, I don't want to indicate that I'm a passive investor or index oriented, but I am curious, when you look at growth versus value indexes over the last 10 years, growth has trounced value. And my question is, what's behind that, and was it predictable 10 years ago?
Well, the first thing that we get wrong is that if you look at the economics of the value indices, right, the economics of these businesses that are in the value indices are really not that robust of a business. Low PE stocks typically are very capital intensive. They don't grow very much. They don't generate high returns on capital. And so therefore, I wouldn't be surprised at all that a business like that would have a hard time outperforming a business that's a high PE stock that has the attributes of faster sales growth, more cash generation, high returns on capital. The problem that we run into is that decades and decades ago, we thought high PEs were bad and low PEs were good. And that was true for a while, particularly when you go through nasty bear markets like 73 and 74 in the technology. But I think now if you took the composition of all the Russell 1000 growth companies and took the composition of all the Russell 1000 value companies and give me the economics of that basket and the economics of that basket, and tell me, what do you think will outperform economically speaking for the next 10 years? It was a no-brainer. I mean, that was what you should have done. So I'm not quite surprised at all. What irritates me is that someone says those high PE stocks are not valuable. Well, hell yes they are. They just went up about 10 times where you sat there and did nothing if you were bought low PE stocks. So it's a misnomer that low PE is a great investment and high PE is a bad investment. That's not the way it works at all. Does that make sense?
Next question.
Yes, thank you for all the good information from the panel. This is a question for Susan. You had made a comment that you focus in on turnaround businesses, and I seem to recall reading something from the Buffett information that says most businesses, turnaround businesses, don't. So evidently you found some secret sauce, and could you share that with the group?
Yeah, I do. It is my secret sauce. Exactly. How does that work? All right, so I do think that, and I'm sure each of us up here have something that we see in a business that we know, that appeals to me particularly. I know, I feel good about that, and it's a story that I like. I'm terrible at commodities. I don't own a single commodity stock. If someone said, okay, well, steel's runny, we ought to own a steel company, I don't care. I know I'm going to lose money on it. I don't care if I buy it at the absolute bottom. I will ride it up. I will ride it down. I'm just not good at commodities. Turnarounds, I actually feel really good about those. So contrary to, Warren, there's a difference between turnarounds where you've got a base business and just bad management, and then you've got some people who go in and try to save a business and turn it around, but it's a bad business to begin with. So there is a differentiation between the two. And I've got an inside advantage because I've run an industrial company. I've changed an operating line. I've had a union workforce. I've had to ship my product all over the country. I've had to worry about my factory. So I have a better sense, and when I'm visiting a business, particularly a widget business, I have a really good feel for that. So that happens to be my secret sauce, and I gravitate to those. But on the other side of that, I don't buy anything that's a commodity company, because I know that's just not my affinity. And I'm sure everybody here has a certain, when they see something, it perks their interest, and they know they have a skill set that helps them analyze it, and they are attracted to it and look at it.
I think somebody has a question. Right in the front row here. Oh, you got the mic up there? Okay.
Yes. This question is also a follow-up to Susan about your comment about disruption and cash flow. So you said that you don't invest in a business that doesn't have cash flow, but yet business that are disrupting those business doesn't have cash flow.
Right.
For instance, Tesla. And, I've seen Jim Kronos and Einhorn betting against Tesla as a fraud, but it's not on the same equivalent level of fraud, let's say, as Enron. They're betting on innovation.
Few things are.
They're not, well, maybe, that's debatable. But I would like your perspective on how do you view those disruptions, and if you're not going to invest in these disruptions
Right.
without cash flow,
So-
how do you hedge it?
All right, so it dovetails into what I said before about, the portfolios that I'm running right now for my clients. Capital preservation is important to them. And a high-quality business that can preserve capital, for me, generally, my risk protection on the downside is because I've got a business that generates cash. And so, I know David Einhorn. I know what he complains about. I know that he likes to go out there and say these things. And listen, he's been right a lot of times. Lately, not so much. So he's got, I say this to his face, so it's fine. But Tesla, for some people, is going to work, right? If you catch it at the right time, there's a lot of volatility in that stock right now, and I don't need to introduce that into my portfolio. I don't think Tesla's a fraud. I think Tesla can get there, but it's going to be a tough slog. So for my portfolio and the way my portfolio is constructed, I don't have the temperance for the volatility that Tesla can introduce. At some point, I will, because Tesla is going to evolve as a business, and its economic metrics are going to change, and its volatility in the market is going to change, so I can incorporate it into my portfolio. I think when I said not every business is great forever, there is no one great business, it's exactly because of those disruptors. A disruptor can come from all directions, and we are living in a fascinating time that we are seeing them come so fast, and so many of them changing, these traditional ways that we approach things, and that changes what you own. And so, I think disruptors, it all ties together. Disruptors are a part of that, and disruptors can end up being the best thing that you own, right? It can be the threat that makes you get out of one investment, wait 2 years, and it could be something that's so excited that you get into it on the other side.
I have a question about managing your emotions while investing. I read, Ray Dalio says, he uses meditation. Is there one thing that you guys do that helps you manage your emotion?
Exercise.
Yeah.
Exercise is critical for managing your emotions, your stress, keeping present in the moment, and keeping a good perspective on everything. So for me, at least, that's a core part of it.
Yeah, I just stay objective, and that's really hard. So do whatever, if it's meditating, do whatever you need to do. I love spin class. I have a bad week in the market. I will take 5 spin classes over the weekend. So I'm not kidding. So it's, do what you need to do to vent, because you need to go in and that's the hard, you're always fighting. It's the opportunity in the market and the danger. You're always fighting human nature. So you have to stay even keel, and logic, not emotion, has got to rule your decisions.
Can I just suggest you need to study it? There's a whole field of behavioral finance. I spent years, my entire career studying it, but there's a foundational literature. If you're reading The Intelligent Investor and coming out here to the Berkshire meeting and you're studying investing, and you don't spend almost as much time, if not more time, reading Thinking Fast and Slow, Influence, reading all of Thaler's, there's a whole body of literature. In fact, to learn it myself, I developed a big PowerPoint presentation and teach it. You want to learn something, teach it, because it is so important. So it's even after studying it, and I have a list of at least 25 behavioral, emotional traps that investors typically fall into. Number one is overconfidence. And you need to study it closely, because that's your only hope of overcoming it, because we're all hardwired to be emotional and irrational when it comes to financial decisions. But at least if you study the literature and the research and understand the traps that are out there, you have some chance of avoiding most of them.
That's a good point, and I think particularly for the students in here, that's table stakes. Like the behavioral finance literature, all those books that are out there on the shelf, to be active and competing, if you will, because we are all competing in this world, that is just to get a seat at the table. So.
Right. And by the way, then you need to go out and study case studies. So go out and study, everyone, all you guys, one of the absolute crimes of business schools is they only teach success stories. So you read about all these successful investments, and every smart money manager comes in and does a victory dance on, I bought Netflix at the bottom. I didn't study one case study at Harvard Business School of an absolute train wreck, of somebody who lost all their money, who made the wrong decisions, who fell into these emotional traps. It is a crime to teach anything, but especially investing, without spending 50% of your time teaching mistakes. I was teaching seminars for the past year, and I taught the biggest mistakes in my 20-year career, spent as much time in my seminars, and the students were like blown away. They're like, I was the first person who ever confessed to making a bad investment, that they'd ever heard speaking. But that's what you have to study. Go study Valiant and find out how 5 of the world's smartest investors collectively probably lost $15 billion on one stock. How did that happen? And it wasn't one mistake. It was Lollapalooza effects of overconfidence and having anything you make a lot of money on, it completely blinds you. 4 of the 5 made a ton of money on Valiant. That blinds you to the story changing and realizing Mike Pearson's a crook. Somebody makes you a bunch of money. Very hard to think that guy's a crook, right? I could go on. Valiant's the single best case study out there, both on how to make 20 times your money in 6 years and then how to lose 97% of it in 18 months.
By the way, Warren always talks about his mistakes also. He's made very few, but he always emphasizes his mistakes. There's somebody on TV that screams and yells all the time that has never made a mistake.
Sure. How did he make a mistake on IBM, right? It was blindingly obvious that was a value trap. I wrote him a letter the day after he disclosed it, and I never do that because it pisses him off. But it was just such an obvious mistake. How did Warren Buffett make that mistake? And the answer is super simple. He's an old guy who grew up investing in the 50s and 60s where nobody ever got fired for buying IBM. He anchored on historical perceptions, the historical IBM, the bluest of blue chips, right? And that's one of those mental mistakes you can make. Anchoring on ancient history as opposed to what the reality and what the future looks like.
Got a question right here.
Yeah, I guess it goes back to that debate between growth and value, but one of the trends that we're seeing at the moment that companies invest a lot more in intangible assets rather than actual tangible capex, whether that's software R&D, branding. I guess these businesses are so easy to scale now. Does that mean that our kind of concept of value or the way that we look at value has to change given the increasingly different economics that we're seeing in a very large collection of companies?
Well, yeah, I think so. I mean, Warren, has talked about a lot. You said last year, you just can't fathom how these companies with so little capital have grown so fast, created so much market cap, and generated so many billions of dollars. It was an S-curve phenomenon. Most innovation things are S-curve. They plot along, and you don't really pay attention to it, and all of a sudden they just take off. And people are really kind of struggling, trying to figure that out. But there is so to the Russell 1000 growth versus the value. If you go back 10 and 15 and 20 years ago, the composition of the growth sector didn't really have that many really great cash-generating businesses. There was a lot of fluff in there, and the value had a lot more really good businesses. But to your point, what's happened over the last 10 or 20 years, that which is morphed over to growth, which is faster growth, doesn't need as much capital, generates a lot of cash. All of a sudden, this group now has become really quite valuable, and the stuff that's been left in the value camp now has been subservient or less attractive business-wise. So we're hung up on, in the old days, that value used to be growth, but the data's non-stationary. It's not the same companies 20 and 30 years ago that are populating that data set. The new data set has different population sets. And so you've got to think about that. So yeah, the biggest struggle that value investors have is the inability to give up thinking about the valuation of something as a low PE being good. Low PEs don't tell you anything about value. They are the summation of the economics of the business. Then you've got to figure out, is it mispriced relative to the market? Something that goes fast, generates high returns on capital, and generates cash should have a high PE. Something that goes slow, is capital intensive, and doesn't generate high returns on capital should have a low PE. Then you got to figure out, is it mispriced?
And if you think about them as businesses and not as stocks, it allows you to get away from a value or growth arbitrary distinction.
Exactly.
And I think Morningstar lives to have boxes.
Oh,
Consultants
consultants live to have
boxes. It's like, but if you are just thinking about investing your own money, just think about it as a business and say, what is the run rate of this business? What's its profitability? How much capital does it need? What's its competitive advantage? How sustainable is it? Am I willing to own this for 5 or 10 or 15 years? And it gets you outside of the arbitrary labels that people put on stocks, as opposed to thinking about them as companies and thinking about them as actual businesses. My brother's a money manager. He's a quant, and he runs a series of quantitatively driven funds. And the joke is, he'll call me up and say, hey, what are your favorite ideas? What do you own? I'll say, yeah, we own Apple, we own MasterCard, whatever. I'm like, what do you own? He goes, I don't know. We just own what the computer tells us to own every month. He goes, because we've got factors, right? And he's like, well, we got a size factor and a value factor and a momentum factor. And I'm not denigrating my brother. I would say this if he was here, because I've said it to him like you to.
You probably denigrated him your whole life. So.
Pretty much. Actually, he's my younger brother, so I can say it. But I always tell him, I'm like, Bob, what you're looking at are outputs as opposed to, from my worldview, it's like you are investing in people, you're investing in a company, you're investing in an organism. And the factors of it's a value stock or it's a large cap stock, those are kind of in a sense, or Susan said beta, that sort of already happened. And I think you get paid for understanding what is going to happen. So I sometimes ask myself, how did we ever decide to buy Amazon in the first place? I mean, 10 years ago, it's like, it was almost an embarrassment in the sense, particularly like living in Omaha, it's like, well, geez, it's like, that's not a value stock. It's like, well, it's not, but it's more an understanding of what that business might be capable of doing and what is the trajectory that they're on and what are their competitive strengths. And so again, getting outside of what label or what bucket should it be in is maybe helpful to thinking about it really as a business owner and what I'm going to own for the long run.
And Ted brings up something really important, and he said it right. They're both looking at the same stock, but they're both playing different games. The game that his brother's playing is using data inputs to make decisions about how to buy and sell the stock. That's different than the inputs that he's using to buy and sell the stock. So when you see a stock price move, you really have no idea, is that the counterpart to your game playing with you?
Right.
Or is it the counterpart of somebody else playing a totally different game? And if you can't figure that out, you're really toast. So that's where you go back to the economics that Ted says. What do I own and what's the economic return? Because the pieces on the board are moving because there's so many games being played at the same time by different people using different rule sets. And if you think that you're playing everybody else playing the same game as you are, totally wrong. That's not the way the market works at all. So that's why you got to know what you own and the economics of what you own.
I think we've got time for one more question.
Thank you. I got a question on circle of competence and the size of the management or investment team. So for a single hedge fund manager who has his own or her own circle of competence versus having a big analyst team with their circles of competence, can you comment on how you allocate your portfolio versus on your own versus analyst and how that kind of works?
Well, I'll give a quick. So even though I'm the portfolio manager, we're all analysts. We don't really have a distinction between PM and analyst, where the PM doesn't really know what's going on and the analysts do. On circle of competence, I would add, it's not necessarily how big it is. It's pretty important to know where the line is, right? and then always be trying to deepen it and grow it to adjacencies. And so, yes, it's a wonderful thing to be able to layer various circles of competencies and networks on top of each other, and the sum is hopefully greater than the parts. But it's way more important to know where the line is and try to stay within that line.
My advice to any young person is Charlie Munger once gave a good analogy. He said, when you're young, let's talk about tennis. And he said, you should work on your forehand, your backhand, your serve, your net game, your slices, your volleys, your drop shots, whatever. But he said, at some point, if you've got the world's best forehand, you should structure your life to pound forehands all day long. So my suggestion would be similar in investing, which is when you're young, try and build a big toolkit, look at a lot of industries, a lot of companies, and always be trying to expand your knowledge base. But to really succeed, I think you do need to specialize and have something that's really one or more areas that's just your sweet spot, where you have just gut knowledge, connections, relationships, and can get that kind of scuttlebutt research that is possible in a world of Reg FD. My most successful investments over the years have generally been where I sort of knew somebody, or just something like Berkshire. I made more money. I owned Berkshire for 20 plus years, but I made more than the stock did over that 20 plus years, because there were two incredible opportunities to buy Berkshire and two very good opportunities to buy Berkshire in 20 years. And because I knew the stock so well, I was able to buy it when it was trading at cash and investments in late 08 when AIG blew up that week. I was able to buy it. I made it a 30% position in my little fund in March of 2000. At the day the NASDAQ peaked was the day Berkshire bottomed at 40,000, right? You want to become a real expert in a few companies or industries or countries. It could even be a country that you really specialize in. By the way, I've got so many ideas I want to share. We've run out of ideas. I spend 1 to 2 hours a day putting together a free daily email. I've been doing it for 20 years. I've got 14,000 people on my list. So if any of you are interested in being on it, just go to empirefinancialresearch.com and pop your email in, and I'll send you daily musings. Like today, I was just commenting on the investment in Amazon, Berkshire's investment in Amazon.
I would like to just close with the following thought, is today was all about education. We're in an academic institution.
I hope that you picked up some nuggets here, that you increased your circle of competence, if you will. You increased your toolkit. I really believe that my education in investing started in the mid-'80s, and I wish I knew exactly what year it was, but I can't remember, when I went to my first Berkshire Hathaway annual meeting. And I was a student here at Creighton in the MBA program. And I went to the Joslin Art Museum. The meeting was at the Joslin Art Museum. And I believe there might have been 200 people there. And the reason I went was not because I was so enamored with Warren Buffett or Berkshire Hathaway. I was a shareholder, but I was a shareholder because I went to school with his son Peter at Central High School. It was an accident of birth. It was the first stock I ever bought. But I walked in there, and I went there because there was a free lunch. And when you're a student, a free lunch is pretty important. When I listened to Mr. Buffett, there was something different. And I've enjoyed listening to him, and it's true north. And I think Whitney said it, that you can get caught up in a lot of things, and that you come here once a year, and you kind of get your rudder back. And I hope that you increased your education here. I just want to call out one individual in here about education. Charles Roteblatt. Charles, stand up. Charles Roteblatt is with the American Association of Individual Investors. I'm not being paid by AAII to make this pitch, but if you want to increase as an individual investor, if you want to increase your knowledge base, one of the best values is AAII membership. How much does it cost, Charles? $29 a year. There's a journal that's published every month.
Correct.
And it's really good, solid information. And it hits the mark. So if any of you are interested in continuing your education in this area, I think that's the best value there is out there. But I thank you for coming. Thank you, panelists. That was terrific. And there'll be more than a couple 150 people there tomorrow, by the way, if you don't know.
Hi, everyone. My name is Morgan Malo. I'm a senior finance and accounting student in the portfolio practicum class. As Doctor just said, thank you, panelists, for coming. I know it's a crazy weekend, and we really, really appreciate you guys coming here and sharing your expertise with us. This has been an awesome panel, and we just really want to thank you. So another round of applause for our panelists, please. I'd also like to take a moment to thank our moderators, our professors, and everyone within the Heider College of Business that helped make this success, and thank you all for coming. There will be a reception up in the atrium right now. Feel free to join us and continue on in conversation. Thank you.
Thanks very much. Appreciate that.
Storage tanks, it was